exercise the option. So we're going to talk now about how to calculate the exercise value for an option, and we're going to look at the exercise values for calls and the exercise values for a put. So I'm going to go back over here to the option quotes for Apple. And so again, these are for the options that will expire on June 19th, 2020. And these are the in-the-money options, meaning that if I purchase one of these today, I could actually exercise it and I would receive either shares of stock that I could sell for a higher price than what I bought them for, or in most cases, the option writer, the person who sold me the option, will just give me cash, the cash difference. So let's take a look at this. I want to find an option that's been traded recently. You can see again the last trade date. Some of them go back quite a ways. Here's one traded on 4/18. Today is 4/19. So this has been traded recently. The strike price or the exercise price is $150. And the current price of this option, if I wanted to buy it today, would be $58.50. What I'm doing off the camera here is I'm writing all this down, so I'm going to go back to the notes here and use this as an example. And the current stock price is $203.86. All right, so I'm going to switch back over to the notes now. And so I've got the exercise price here is $150. The stock price today is $203.86. This is the price the option's selling for right now, or if I wanted to buy this option, I could pay a dealer and they'd sell it to me for $58.50. It's not that important for our next few, or for this example, but it's something I want to discuss after we get through the example here. So the exercise value of my option is equal to the maximum of the current price of the stock minus the strike price, or 0. So in our example here, the stock price is $203.86, the exercise price is $150, and so my exercise value is equal to the maximum of the current current price of the stock, so it's $203.86 minus the strike price of $150, or 0. So if I do the math here, it's equal to the maximum of $53.86, or 0. The maximum between those two numbers is $53.86. So that's my exercise value. What that means is that if I bought this stock option today, I could go out and I could look at the writer and say, okay, I want to exercise my option. In that case, with a call option, what they're going to do is they're going to sell me the share of stock for $150. So it's worth $203.86. I can turn around then, because I just bought the option for the, I just bought the stock from them for $150 a share. I can turn around then and sell that stock for $203.86, and this is how much money I'll get from that. Or what typically happens is that option writer is just going to give me this dollar amount. It saves on transaction costs when they do that. But it's up to me, the option buyer or the investor, to determine how I'm going to receive that. So once again, what happens with a call option is that when it's exercised, the option writer or the option seller, they're both the same person, is going to sell me the stock for the stock price. Okay, so again, a call option gives me, the investor, the right to buy the stock at a specific price, predetermined price, and that price is the strike price. So it gives me the right to buy buy the stock for $150, buyer on a predetermined date. In this case, the options we were looking at expire in June of 2020, and so that would be that date would be the date that the option expires. If I don't exercise the option by or on the expiration date, the option's dead. Okay. So the day after that expiration date, the option doesn't exist anymore and I can't exercise it. What I want you to see here is that it wouldn't make sense for me or anyone to go out and buy that option today with the idea that we're going to turn around and sell it and make this much money. Because this is the price of the option today, $58.50. So if I tried to do that, I would actually lose, a little less than $5 on the trade, because I'm paying $58.50 for this option that currently has an exercise value of $53.86. If this value were more than this value, I could that would create an arbitrage opportunity where I could just go out and buy shares of buy these options, exercise them immediately, and make a profit. So the option dealers won't let that happen because they're the ones setting the prices here. All right. So let's look at the exercise value for a put. So the exercise value of the put is equal to its strike price minus the current price of the stock, or 0. Remember, the put option gives the investor the right to buy the stock at the strike price. So the goal, if you're buying a put option, your expectation or your goal is that the stock price falls, because that's how you make money. The strike price doesn't change, so you're going to make money if the stock price falls. So let's look up a put option here. So I'm going to go back out here to, I'm here at the options. You scroll down on Yahoo Finance, you get to the puts here. Let's find one again that's been traded recently. We've got this one here, Apple. Again, it's $150 for the strike price. It is currently being traded. If you wanted to buy this today, you'd pay $3.75. Actually, this is not an in-the-money option, so what we want is in-the-money option. So we're going to have to scroll in here. Sorry about that. All right, so for a put option to be in the money, it needs to be, the strike price has to be greater than the current stock price. So let's look at this one here. A recently traded one. It's right here. It's $300. So the strike price is $300. X is equal to 300. Again, the current stock price is $203.86. And this one, if I wanted to buy it today, I'd have to pay $97.55. So again, here's my strike price, here's my stock price, here's my the price of the option today if I wanted to buy it. So the exercise value of this option is equal to the maximum of the strike price, 300, minus the stock price, 203.86, or 0. So this is equal to the maximum So this is equal to the maximum of 300 minus 203.86, which gives me a value of $96.14, or 0. So the exercise value is equal to $96.14. Again, the term here, max, means what is the highest number of these two. I'm going to show you a quick example of an out-of-the-money option just to demonstrate this. But what I want you to also see here is, again, we have this situation where I could buy this stock today, and if I exercise this, I could buy this option today, and if I exercise this option that has an exercise value of 300, an exercise price or a strike price of 300, I could exercise it and receive $96.14. However, it wouldn't make sense for me to do that because I'm paying $97.55 for this opportunity. So let me show you just briefly. So these are both in the money options. In other words, they have a positive exercise value. This value is positive, meaning that they're both in the money. What I want to show you very quickly is an example of out of the money options. So just to show you why this max is important. So if I have an out of the money option for a call option, this means that the current price of the stock is less than the stock price. So we'll say S is equal to 50. X, the strike price, is equal to 60. So my exercise value is equal to the maximum of 50 minus 60, or 0. And that's equal to the maximum of negative 10, or 0, is equal to 0. Okay. So in this case, if I own this option and we are at the expiration date, I would not exercise the option. Because if I exercise the option, what I'm doing is, remember, this gives me the call option gives me the right to buy the stock. So I would be buying the stock from the option writer for $60, but it's only being sold in the market for $50. So that wouldn't make any sense because me, in my role as the option investor or the option buyer, I would be losing money. So I would just choose not to exercise. And as the option investor, I have the right not to exercise the option. For the option writer, they don't have that right. If I go to exercise the option, they have to go ahead with the exercise of the option. But in this case, because this is an out of the money option, I would not want to exercise it because I would actually lose money. So that's why that max is in there. And the second argument in that is 0, because if this is negative, we won't exercise. And so we would just end up with 0. So for a put option, we would use something opposite. So again, this is an example of that. We've got a stock price of $50 again, but our strike price is equal to $60, or excuse me, our strike price is equal to $40. Okay, so remember, the exercise value of a put option is the strike price minus the stock price. Is equal to the maximum of X, 40, minus S, 50, or 0. And again, we're going to have maximum of negative 10, or 0. So I would not want to exercise that option either, because what would happen is that the put option gives me the right to sell the stock for the exercise price to the person who sold me the option. So in this case, if this were the expiration date and these were my values, I would be requiring the option writer to buy the stock from me for $40 when it's really worth $50. So if I have this share of stock, and we'll talk about a strategy where people do this, if I own this share of stock, my option on the expiration date, if I want to get rid of the stock, is to either sell it to the option writer, the person I bought the option from, for $40, or just sell it on the market for $50. So most rational people are not going to sell the stock for less than what it's worth. They're going to sell it out here on the market for $50. The goal of the person who's buying the put option is to take advantage of a decrease in the stock price. So they would want to engage in this option if they felt like the stock wasn't going to increase in value. And we're going to look at some strategies here in a little bit using these different ideas. So the option profit to the holder, and this does not include transaction cost. The profit for an option is calculated as the option profit is equal to the exercise value minus the option premium. So let's go back up here to this example using Apple stock and that option that we looked up. So the option profit using this information up here is equal to the exercise value. So our exercise value was 53.86 minus my option premium of 58.50. Or negative $4.64. So what I want you to know about this, even though if we purchase this option today and we get to the expiration date and this is the outcome, we would still exercise this option because we paid $58.50 for this option. By exercising the option, we're going to recover $53.86 of that. So if we don't exercise this option, we're going to lose $58.50. But if we do exercise the option, our loss will only be $4.64. Hopefully, by the time of the exercise date or the expiration date, the exercise value will be greater than what we paid for the option, and so we show a profit from our strategy. So let's go down to the next one. So this is the profit to the holder or the investor. The option profit to the writer, again not including transaction costs, is equal to the option premium minus the exercise value. So going back to this first example here, our option premium was $58.50 minus our exercise value of $53.86, which is just the opposite of this up here, $4.64. So in this situation, again, if this were the expiration date and these were our prices, the option holder, the person who bought the option, would receive a profit of $4 or negative $4.64, so they'd lose a little money on that. The option writer would benefit and they would show a profit from writing that option of $4.64. Just a quick note, when we look up options out online and look at the quotes, options are sold in contracts of 100 units, meaning that when I go to buy that stock option that we saw out here for Apple, each of the units is $58.50. So when I engage in that contract, I'm actually paying 100 times this. So the cost of entering into this arrangement as the investor would be $5,850. So let's move to the next page. Now we're going to get into some strategies and some payoffs, and I'm going to take a few minutes to describe what's going on here. So first thing we're going to talk about is option versus stock investments to kind of show you how the payoffs are different. What I've got a model here, and I've got this in Excel, and I use the Black-Scholes option pricing model. To determine the values that you see here in the table. So this is, in our model, this is the stock price, this is the strike price. Because they're both the same, this is considered to be an at-the-money option. Our other inputs for the Black-Scholes option pricing model is the risk-free rate. So we're assuming that's 2%. Volatility, this is the movement of the stock price So if you think back to when we talked about standard deviations, this is calculated usually as the standard deviation of the stock price for the last 90 days. The time in years, and this is the time to the expiration date. So it's 1 year to the expiration date. The dividend yield is 0. I mentioned earlier how dividends affect the values of options, and in this case we're looking at a call option. It would affect the value of that call option. So in this case we're just saying that it's 0. Using the Black-Scholes option pricing model, we can calculate both the value of the call, or I mentioned before the premium, so this is going to be the call value, or the call premium. This is the price you would pay for this option today. And if you're buying a put option on this, this would be the cost of that put option, or the premium for the put. So in my table over here, I'm giving you the outcomes for every stock price using this call option here, and we pay $7.86 for this call option. So as we can see here, if the stock price is equal to $30 at expiration, we're not going to exercise our call, because our exercise value would be the maximum of S minus X, or 0. In this case, it would be equal to the maximum of our stock price, $30, minus our strike price of $60, or 0. We wouldn't exercise. Okay. We wouldn't exercise this option until it gets up past $60. We wouldn't exercise until the option is up past, or the stock price is above $60. At that point, it makes sense to exercise our option. So I go up by $6 increments here, and you can see here it's $66. My exercise value would be 66 minus 60, or 0, so it'd be $6 or 0. I would exercise. The exercise value would be $6, and my profit would be the cost of my option, $7.68, minus the $6. Sorry, reverse that. $6 minus $7.68 to give me a loss of $1.68. But I'm still better off exercising here, even though I'm going to take a loss, because if I don't exercise, I'm going to lose $7.68. So just to look at another one here, if the stock price on the expiration date is $72, my exercise value is equal to the maximum of the stock price of $72 minus the strike price, or 0. So it's the max of 12 or 0, or $12, and that's the value I get here. The call exercise value is $12. Then I'm going to subtract out the amount I paid. So my profit is equal to $12 minus $7.68, or $4.32. So down below, it shows us the payoff graph for the call option. And so we've got the ending exercise value, or excuse me, the ending stock value down along the x-axis, and my profit, my amount of profit, on the y-axis. In the dashed line, and then the call exercise value as a solid line. You can see that the difference here is constant, and that is actually the $7.68 that we paid for the option. So down below I've got what is the percentage return for a stock investor if the stock price in 1 year is $78. So the percentage return for the stock investor is going to be, and again, this is not for an option, this is just for the stock, means that there's no dividends paid, and so my return is equal to what I can sell the stock for, $78, minus what I bought it for, $60, divided by what I bought it for. So it's going to be equal to $18, the numerator, divided by $60, the denominator, or 30%. 0.3 or 30%. Over here I've got the question, what is the percentage return for an option holder? And this is again a call option if the stock price in 1 year is $78. So let's figure out what our profit's going to be in that case. Our profit, if it's at $78, is going to be our call value minus our call exercise value minus the value of the call. What we paid for it was $7.68, and so the profit's going to be $10.32. So in this case, my profit is equal to $10.32, and what I paid was $7.68 for each option, or excuse me, for each unit that I bought. So my return is equal to $10.32 divided by my invested amount, $7.68. My return is 134%. So, if you're willing to take the risk, options can give you much higher returns for the same change in the stock price. But the downside to this is if the option expires out of the money, then you end up with nothing. You get 100% loss on this $7.68 investment. So here's what happens if the stock or the option expires out of the money. There's no payoff, so my exercise value is 0, and the option simply isn't exercised, and so I just lose out my entire investment that I paid for that option. So call options are a little bit riskier, but they can provide much higher returns, but with the understanding that you could lose your entire investment if the stock price doesn't increase. So the question I have is what are each if the stock price is 60? What if it were 30? Again, we're looking at call options here. So for the stock, if the stock price on the expiration date is $60, the return is equal to 0. And the way we would calculate that is the ending price minus the beginning price divided by the amount we have invested, which would be 0 over 60. So our return would be 0%. For the option, if the price on the expiration date was $60, again, this would be an at-the-money option. So our profit would be negative $7.68. Sorry about that. $7.68, which is what we paid for the option. And so our return would be negative 768 divided by 768 is equal to negative 1, or negative 100%. So we have a negative 100% return in that case. We lost all of the money we invested. Okay. In this case, we just didn't gain anything, but we didn't lose anything. So our return 0. In this case, we didn't gain anything, but we didn't gain anything, and we lost our entire investment, and so our return is negative 100%. for the $30 price. And so this is kind of one of the upsides to using a call option, is that if I own the stock, my return is going to be equal to the ending price minus the beginning price divided by the beginning price. So 30 minus 60 is equal to negative 30 divided by 60, which is equal to negative 0.5 or negative 50%. But I've lost $30. For the option, my profit or my loss stays the same. So this is an out of the money option. My profit is equal to negative $7.68, the same as it was if the money, if the option expired at the money, where I'm not going to exercise that option. So nothing changes for me with the option. And again, my return would be negative 100%. So I'm just going to go back here, flip back to the last page just to show you. The stock price is $30. My call exercise value is 0 because the stock price minus the exercise price would be negative 30. So I'm going to choose that 0 and just choose not to exercise the option. So my profit is negative $7.68. And that is true for all of the outcomes for the ending stock price up to the exercise price of the stock. Anything above that, I'm going to start exercising, because even though I might have a small loss, the loss will be less than what it would be if I didn't exercise. So the first strategy we're going to talk about is called a protective put strategy. And the idea of the protective put strategy is that it protects the option holder from a decrease in stock price for a stock that they hold. So the strategy is to hold the stock. So I buy the stock and I own it, and I purchase a put option. And by doing this, I create a hedge against a decrease in a stock price. And so people that might engage in these protective put options are people that can't sell their stock, but they feel like the stock price might be going down. There are certain trust agreements or certain positions that you're in where you can't sell a stock, or maybe I buy an index. So I own an index fund, and there's big stocks in that index fund. So for example, right now, if I own the S&P 500 index, some of the big stocks, in other words, they have a decent size percent of that index, are Amazon and Apple and Microsoft. And if I thought, I think the market's going to be okay, but I think Amazon's about to get hit. Their stock price is going to take a hit. I can protect myself against that hit by engaging in a protective put, where I'm holding the stock through the index fund, and I'm purchasing a put option to alleviate any downside risk there. So in this situation, the way we create our portfolio is that we buy a share of stock, and buy a put. So the cost of our portfolio is equal to the price of the stock plus the price of the put, which we're going to use a P to denote, which is equal to $50 is the stock price plus $4.60 for our put. So the total cost of our portfolio is $54.60. So here on this table, what I've got is the stock value, the portfolio value. So the portfolio value is the value of the stock with its stock price plus the value of the put, or its exercise value. And so finally, we have the profit. So let's look at this $45 stock value. The stock price is $45, and our option has an exercise price or a strike price of $50. The exercise value of our option remember, this is a put option, so it's going to be equal to the maximum of the exercise price minus the stock price, or 0. So this is equal to the maximum of $50, because that's our strike price. and our current price is $45 or 0, which is equal to the maximum of $5 or 0. So it's equal to $5. So our portfolio value, if the stock price is $45, is $50. Excuse me, not $50, is $45 because we own 1 share of stock, plus $5, which is the exercise value of the put, so it's equal to $50. If our stock is at $50, then our stock value is $50. The exercise value of our put would be 0 because it would be at the money, and so our total portfolio value would be $50. If the stock price goes up to $55, anything above this $50, by the way, the exercise value of the put is 0 because it would be out of the money. We wouldn't want to exercise this option if the stock price was above the strike price, because what that would mean is that we would be selling the stock. If we chose to exercise and we own this put option, we would be choosing to sell the stock to the writer or the person who sold us the option for the strike price, when in the marketplace the value of that stock is going to be higher. So let's say I bought this put option. It's got a strike price of $50, and that means that buyer on the expiration date, I can go out and I can sell the stock price, and I can require the person who sold me the option to buy the stock from me for $50. Out in the market, it's selling for $60. It would be irrational for me to go out and have the writer of the option buy the stock from me for $50 when I could sell it in the market for $60. Right. So let's take a look here at the $60 mark. The stock price is selling for $60. The portfolio value is the value of the stock plus the exercise value of the put. And so that's $60 because the exercise value of the put is 0. The stock price is $60. It's worth that. My profit would be the difference between the portfolio value and the cost of engaging in that portfolio. So it's worth $60 minus $54.60 gives me a profit of $5.40. So let me write in here the profit is equal to the portfolio value minus the cost of the portfolio. And so, just to use one more example here, if my stock value on the expiration date is $100, I'm not going to exercise my put because, again, that would mean that I'd be selling the option writer a stock that has a value of $100 for $50. That just wouldn't make sense to do. So my exercise value for that put option is 0. And so the value of my portfolio is $100, which is just the value of the stock. And I'm going to subtract out from that the cost of engaging in this portfolio because I bought the stock for $50 and the put option for $4.60. So my profit is $45.40. So my profit is equal to my portfolio value, $100, minus the cost of the portfolio of $54.60 to give me a value of $45.40. So this is what the graph looks like in this case. And so this is why it's considered to be a protective put, because if I just own the stock and the ending stock price on that expiration date was $20, this line, the portfolio value, the profit value, well, the portfolio value, if I didn't own that option, would just be a straight line like that, and I would lose money. So using this example, if the stock price went down to $45 and I didn't own the option, then my ending portfolio value would be $45 instead of $50. The next strategy we're going to look at is a covered call. And a covered call position is the purchase of a share of stock with a simultaneous sale of a call option on the stock. It's frequently used by institutional investors, so endowment funds, pension funds, things like that, who plan on selling the stock at a specific price. And whenever an investor plans on selling the stock at a specific price, they might lock in that price by using a limit order. So a limit order is one in which you tell the broker that you want to sell the stock when it reaches a certain price, either an upper price or a lower price. And what this strategy will let people do is to increase the profit on the stock, among other things. This is a fairly common strategy if you're if people want to make a little bit of a profit. And in this situation that we're looking at here, this is an out of the money call. Because the stock price when it's written is $50 and the strike price is $70. So if I purchased this call option, then the stock price would have to increase by $20 before I would consider exercising that option. So the cost of our portfolio in this case, because we're buying a share of stock and selling a call, the cost of the portfolio is buying that share of stock. So the cost of the portfolio is equal to the stock price, which is equal to $50. So let's say we get to that expiration date. And on the expiration date, the value of my stock is $25. But I sold an option. I sold a call option. Now I'm not holding that option. So the option is not in my portfolio, but the cash I received from selling that call option is in my portfolio. So the value of my portfolio is equal to the stock price plus the $1.51 or the call value. So it's plus cash. And then we're going to do one more thing here, and that's the exercise value of the call. We're going to subtract out the exercise value of the call, because once that exercise value becomes positive, in other words, the stock price goes above 70, I'm locked into that price. I can't sell that stock. To me, cannot be worth more than $70, because at that point the person I sold that option to is going to want to exercise that call. So the value of my portfolio, I have a share of stock, I have cash in the amount of the call value, what I sold that call option for, minus the exercise value of my call. So if the stock value is $25, my portfolio value is equal to $26.51, because that's the stock price, plus the cash of $1.51. And then the exercise value of the call is 0, because that the stock price is less than $70. It's $25. So the person that purchased the call option from me would not exercise at that value. It would still be out of the money. So my profit, again, my profit is equal to my portfolio value minus my portfolio cost. And I think I referenced this before as the cost of the portfolio. It's the same thing. So that's going to be equal to my portfolio value of $26.51 minus my portfolio cost of $50 to give me negative $23.49. So let's move up to $70 here. So at $70, my stock is at the money. That option that I sold is at the money. The investor, the person who purchased my stock, is not going to exercise that option because they're not going to get anything for it. The exercise value is 0. So my stock is worth $70. The cash I received, $1.51. The exercise value of is 0, so the value of my portfolio is $71.51. Where it gets more interesting is where we go up in value here. So my stock price, the value of that stock that I purchased is $100, but I've already agreed to sell it for $70. So that's the most it's going to be worth to me. And I received $1.51 in cash. So let's work through this profit here. It's equal to the profit is equal to the my portfolio value. So my portfolio value is equal to $100 plus $1.51 plus, minus the maximum of the stock price, $100, minus my strike price of $70, or 0. So that's the first part. That's my portfolio value right here. I'll make even a bigger parentheses there. So that's my portfolio value, and then I'm going to, for my profit, I'm going to subtract out my initial investment of $50. So my profit is equal to $101.51 minus 30 minus 50. So the minus 30 is that we're subtracting out the call value of the exercise value of the call, which is going to be negative $30. Well, it's going to be $30, but we're subtracting it to make it minus 30 minus $50 because that is my cost of my portfolio up here. Sorry, my $50 there. And so my ending value, my profit from this is $101.50 minus 30 would give me $71.50 minus 50 gives me $21.51. And you can see that at any point above that $70, that's the at $70 and above, my profit no longer goes up because that call option is going to be exercised. So here's what the graph looks like. The value of my portfolio goes up. My profit goes up until we get to that point of $70. So if we could look it on here, it would be $70. Where the ending stock value is 70 is right here. Sorry, this would be 71.51, or yeah, 71.51. Our profit would be 21.51, and this occurs at $70 for our stock price. So what a covered call does is it limits the upside value, but if I already expect to sell the stock at $70 or my strike price, then this is a way I can make a little bit more profit off of my investment. The next strategy we're going to look at is the straddle. And a long straddle, is established by buying both a call and a put option, both with the same exercise price and the same exercise date. A straddle is a good strategy if you believe that a stock is going to have a lot of volatility, but don't know the direction the stock is going to move in. So in this case, we're buying both a call and a put. The strike price or the exercise for both is $50. Then I've got the information here that I made up for this stock. The current price is $50, so these are both at the money options. Their strike price is equal to the stock price when the investment is made. The price of the call is $8.95, so we would pay $8.95 for the call. Our put price is $6.51. And so if we add those together, that's the price of the cost of our portfolio. Sorry about that. Portfolio cost is equal to the value, the price of our call, because we're buying both 8.95 plus $6.51. or $15.46. And I see here, so I did all this in Excel, and so in Excel, because there's no rounding, it was $15.47. So there's a one price difference in what we're going to get here, because I was using Excel here. These are rounded numbers, and so it's off by 1 penny. So what I'm going to show you here is our portfolio value in each case. Remember, our portfolio value is going to be the exercise value of the call plus the exercise value of the put. And the exercise value of the call plus the exercise value of the put. So let's look at our first situation here. The stock value goes down to $10. We have a call option that has a strike price of $50. So let's look at the exercise value of that call option when the stock price is at $10. So we're going to say S is equal to 10. Our exercise value of the call option is 50. So the exercise value of the call is equal to the maximum of S minus X, or 0, which is equal to the maximum of my stock price $10 minus my strike price of $50, or 0. So that would be -40 or 0. So I wouldn't exercise that option. Okay, I wouldn't exercise the call option. Now the exercise value of the put option is equal to the maximum of the exercise value minus the strike price, or 0. So in this case, it's the maximum of $50 minus $10, or 0. So that's going to be equal to $40. So the value, my portfolio value, because I own one call option and one put option, would be 0 plus $40, or $40. My profit is equal to my portfolio value, or my portfolio value minus my cost. My portfolio value in this case is $40. My cost, and like I said in Excel, I'm just going to change this to $15.47. So it would be $40 minus $15.47 to give me $24.53. So profit is equal to portfolio value minus portfolio cost. Let's work one more example here. So this was the stock value falls to $10, but now let's push that stock value up to $90 and see what happens. So just to kind of mirror what we have over here, the stock price is equal to 90. The exercise value of the call is equal to the maximum of S minus X. So in this case, it's 90 minus 50, or 0. I apologize, I'm getting kind of small there. 95 minus 50, or 0, is equal to $40. So it's 90 minus 50 is $40, which is the maximum, and 40 is the maximum between 40 and 0. So that's what's going to go in there. So the same thing for the put, exercise value of the put and that's going to be the maximum of the strike price. So our strike price is $50 minus the stock price of $90, or 0. So that's going to be equal to 50 minus 90, or negative 40, or 0, 0. We wouldn't exercise the put in this case, because again, what we would be doing is we would be telling that the person who sold us that option, that they had to buy our stock from us for $50 when we could just sell it on the market for 90. So that wouldn't make any sense. But in the case of the call option, we would be telling the person who sold us the call option that they had to sell the stock to us for $50, and then we can turn around and exercise that, we can turn around and sell that same share of stock in the marketplace for $90, giving us an exercise value of $40, and then our profit is that $40 minus the $15.47 that we paid to enter into that portfolio. So the place where this portfolio won't give us a profit is this range right around the exercise value. It's right around that exercise value. So the idea here is that we're buying the call and the put at the current stock price. So this is, when we purchase it, this is an at the money call, and at the money put. And if the stock price goes up a lot or down a lot, we make a profit. If the stock is boring and it doesn't do anything, we don't make money on this one. So for example, if you look at a stock that might be a little volatile, so it may be Tesla. Elon Musk goes on Joe Rogan's show again, you could make some money. Okay, stock price could go down a lot. Elon Musk comes out and says that he's settling down. He's going to calm his life down a little bit and really focus on selling cars and vehicles and solar panels and all that good stuff. The stock price might go up a lot. But if you engage in this option, you're betting on a change in the stock price, not necessarily that the stock price is going to go up or down, but that it's just going to be very volatile. The next strategy is kind of a different strategy, and it's called a spread. And we're not going to work through an example of this because there's so many types of strategies or portfolios you could construct for this, but I do want to explain to you what a spread is. A spread is a combination of two or more call options or two or more put options on the same stock with different exercise prices or times to maturity. So you can see here that there's a vast number of different assets you can buy or sell in order to create a spread. Some options are bought, whereas others are sold or written. A money spread is the purchase of one option and simultaneous sale of another option with a different exercise price. A time spread is the sale and purchase of options with different expiration dates. One example of a spread is called a bull call spread. And with a bull call spread, what I would do is I would buy an option. I'm buying a call option. At a certain exercise price and a certain time to expiration, and I'm selling a call option on the same stock with a higher strike price. So what happens in the bull call spread is that I'm expecting the stock price to go up, but only a moderate amount. So what would happen here is that I buy the option, which benefits, I benefit if the stock price goes up. And then I sell a call option with a higher strike price, and that there's a lower likelihood that this option will be exercised because the stock price would have to go up higher. However, this call option that I sell, the call value or what I'm going to receive from the person who buys it is going to be less than what I pay for the call option that I buy. But the purpose of this spread is to lower my cost of engaging in this position. because when I sell this call option with a higher strike price on the same stock with the same expiration date, they're going to pay me, the person who purchased it is going to pay me money, and then I'm going to use that money plus a little of my own, because this option is going to be a little bit more expensive, to buy this call option. But overall, the strategy here of the spread is to reduce my cost of engaging in purchasing in this original call option. Kind of the same idea with a time spread is that I would sell an option with a shorter expiration date, and then I would buy an option with a longer expiration date if my goal was the same, reducing the cost of this of purchasing the call option. Because the longer the time to maturity, or excuse me, the longer the time to the expiration date, the more valuable that call option is. So that's an idea of a spread. The caller is a more specific strategy, and it's one that's actually used quite often. So when we engage in a caller strategy, it's a strategy that brackets the value of a portfolio between two bounds. An example of a caller is buying a put option and writing a call on the same stock. It restricts both potential losses and potential gains. So in this example, we're buying a share of stock, we're buying an out-of-the-money put, and selling an out-of-the-money call. So we're buying a share of stock that costs us $20. We're selling an out-of-the-money call, and the strike price of that is $28. So it's out of the money because the 28 is greater than the stock price. And then we're buying an out-of-the-money put. The strike price for the put is $12. And so that's out of the money because it's less than the current stock price. The call price is $1.25. We're selling it, so we're going to receive $1.25. We're going to buy an out-of-the-money put. That's going to cost us 21 cents. And then we're buying the stock, and it's going to cost us $20. So the cost of our portfolio is equal to the $20 that we paid, the $1.25 we received for selling the call, and then the 21 cents that we paid for the put. So it's equal to 20 plus $1.25 minus 21 cents, or $21.04. All right, damn it. So the cost of our portfolio is equal to the price of the stock plus the price of the put option that we're buying minus the $1.25 that we're getting back from selling the call option. So our total price, our total cost of our portfolio is $20 plus 21 cents minus $1.25, which is $18.96. So let's take a look at the values of our portfolios at different stock prices. So our portfolio value is equal to the stock price, because we own that, plus we own the out of the money put, so it's the exercise value of the put minus the exercise value of the call. So minus the exercise value of the call. And we subtract out the exercise value of the call because at amounts greater than $28, that call is going to be exercised by the person that we sold it to. So let's do two examples here. We're going to do the example at $4, and then we're going to do the example down here at $36 and see where we get our profits and our portfolio values. So if the stock is selling for $4, the value of the portfolio is the stock price, which is $4. So stock price is equal to $4. So our portfolio value is equal to $4 plus the value of our put, or exercise value of our put, plus the maximum of the exercise price, which is $12, minus the stock price of $4, or 0, minus the exercise value of the call, which is the maximum of the stock price, $4, minus the strike price of $28, or 0. So the maximum of 12 minus 4, or 0, so this is 8 and this is 0. And the maximum of 4 minus 28 is, well, 4 minus 28 is negative 24, or 0, so the maximum here would be 0. And this is going to be 12 minus 4, or 8. So the value of our portfolio is $12. 4 plus 8 plus 0. Okay, so that's where we get this number right here. Portfolio value of $12. Our profit then is the difference between what the value of the portfolio is minus the cost of the portfolio. So profit is equal to $12 minus $18.96, or $6.96. So that's where we get those numbers up there. Let's look down here at 36. So let's work another example here. Our second example is going to be using the stock price of $36. So that's our ending stock price. Our portfolio value, again, is equal to the value of the stock price plus the exercise value of our put option minus the exercise value of the call option. And the reason for this is that we've purchased a put option, so as that increases in value, that increases the value of our portfolio, and we've sold a call option. So as that exercise value increases, it decreases the value of our portfolio. So our stock price here, down here at the bottom, is $36. The exercise value of the put option is equal to the maximum of the strike price, and our strike price over here was $12 minus the stock price of $36, or 0, minus, so we're subtracting out the exercise value of the call, which is the maximum of the stock price, $36, minus the strike price, and our strike price was $28. 0. So this is going to be equal to 36 plus 0, because this is 12 minus 36, or negative 24. So the maximum of negative 24 and 0 is 0. The maximum of 36 minus 28 is 8, or 0. So it's going to be 8 minus 8, and this is equal to $28. So our ending portfolio value, if we do this straddle, or excuse me, if we do this collar strategy, it's going to be $28 if the ending stock price is 36. Our ending portfolio value, if the stock price falls to $4, is going to be $12. Our profit in this last case then is going to be equal to the portfolio value of $28 minus the investment we made to engage in this strategy of $18.96, or $9.04. And that's what we get down here at the bottom. $9.04 is our profit. All right, so let's take a look here at the graph. The graph of the collar looks like this. As you can see, again, it limits our upside, but it also limits our downside. So this is the portfolio value for different stock prices on the expiration date, and this is our overall profit. If the stock price falls, then we're going to lose a little money here, but it limits our losses, and so our loss can't go anywhere below this minimum value of $6.96. So that's the hedging part of the collar. The limiting the profit, the maximum profit, helps pay for this hedging situation because we're getting money from selling this call option. So our maximum portfolio value is $9.04. This is negative $6.96, and so we've locked in a range that we can come up with in terms of profit here, limiting our downside, and in order to pay for this hedge, we're limiting our upside as well. So the collar is often used to hedge against risk, and the upside is limited in order to help pay for this locking in this downside. Rise considerably for these to be exercised. After the stock reaches the conversion value of the bond, the value of the bond is based on the value of the underlying stock. Warrants are essentially call options issued by a firm. The difference between a call option and a warrant is that with a warrant, a new share of stock is created when the warrant is exercised. Warrants also result in a cash flow to the firm when the warrant holder pays the exercise price. Oftentimes, you'll see warrants attached to other securities, such as a bond. So sometimes you'll see bonds sold with warrants attached. Executive stock options are oftentimes warrants. So again, the difference between a call option and a warrant is that a new share of stock is created when the warrant is exercised. Oftentimes, and sometimes with executive stock options, if they aren't warrants, what the company is doing is they're repurchasing shares of stock out on the market and just holding on to those shares of stock to make them available when the executive exercises their option. So, but if you ever hear of a security that has a detachable warrant, or just a warrant, it doesn't have to be detachable. This is what they're talking about. Essentially, it's just a call option. A collateralized loan is essentially an option with the collateral as the underlying asset and the principal value of the loan as the exercise price. So what that means is that if I take out a loan and the value of the loan is $100,000, and I use it to purchase a piece of land that is $120,000, at least when I buy it. If the option is exercised, meaning I default on the loan, then the bank goes and collects my property and sells it. Okay. They get the $100,000 plus whatever, interest, things like that, and then I get the remaining value. Okay, I receive the remaining value, $20,000. However, let's say that I take out this $100,000 loan, and we have, I don't know, a financial crisis where the value of real estate drops considerably. Now my value, the underlying collateral, the land, drops in value. to $80,000. What happens then is that, and I don't make my payment, in other words, I exercise the option, I don't make the payment, then the bank takes my land and sells it, gets $80,000, and I still owe them $20,000. Right? I still owe them $20,000. So the collateralized loan is the value, again, the value of the loan is that exercise price. If the value of my underlying collateral goes above that amount, again, I wouldn't recommend doing this, but you can exercise that option by just defaulting on the loan. Finally, much like collateralized loans, equity in a corporation with debt is like holding a call option with the exercise price being the value of the outstanding debt and with the underlying asset as the actual assets of the firm. Okay. So if the value of the firm or the value of the firm's assets exceed the value of debt. And let me make one clarification here. This would be the market value. In other words, what's the market value of the firm in total, of their assets? So when we think about this, it would be the market value of the total firm, the market value of equity plus the market value of the firm's debt, because combined that's the market value of the firm's assets. To the degree that they exceed the value of the debt, our equity has value. Okay, if the value of the firm's assets, the market value of the firm's assets, ever fall below the value of the debt, oftentimes that company is going to be in bankruptcy, and the value of equity is going to be zero. And that's it for this topic. Let me know if you have any questions.